Buffett's tips for beginners in the stock market. Welcome to the channel, where we break down timeless ideas, powerful strategies, and real-world lessons that help you understand money, markets, and long-term success. Today, we begin a new journey into Warren Buffett's advice for beginners in the stock market, focusing on the mindset and foundations every new investor must understand before risking a single dollar. 1. Start with the right mindset, not fast profits. Warren Buffett often says that investing is not about getting rich quickly, but about building wealth patiently. For beginners, this is the most important lesson. Many new investors enter the stock market hoping for quick wins, chasing hot stocks, trends, or tips from social media. Buffett strongly warns against this behavior. According to Buffett, the stock market is a place where money moves from the impatient to the patient. If you approach investing like gambling, emotions will control your decisions. Fear makes you sell at the worst time, and greed makes you buy at the top. Buffett believes beginners must first train their mindset to think long-term, sometimes for years or even decades. He advises investors to imagine that they are buying a business, not just a stock ticker. If you wouldn't buy the entire business and hold it for a long time, then you shouldn't buy even one share of it. This mindset protects beginners from impulsive decisions and emotional mistakes. 2. Learn before you invest a single dollar. One of Buffett's most repeated tips for beginners is education first, money second. He famously says, "The best investment you can make is in yourself." Before entering the stock market, beginners must spend time learning how businesses work, how markets behave, and why prices move. Buffett did not start by investing blindly. He spent years reading financial statements, studying companies, and understanding economic cycles. He still reads for several hours every day. For beginners, this means learning basic concepts such as revenue, profit, debt, cash flow, and competitive advantage. Buffett warns beginners against investing in things they do not understand. If you cannot explain how a company makes money in simple words, you have no business investing in it. This principle alone can save beginners from massive losses. 3. Stay inside your circle of competence. Another critical Buffett lesson for beginners is the idea of the circle of competence. This means knowing what you understand well, and more importantly, knowing what you do not understand. Buffett admits that he avoided technology stocks for many years, not because they were bad, but because he did not fully understand them at the time. For beginners, this is a powerful lesson. You do not need to invest in every popular sector. You only need to invest in businesses you can analyze confidently. By staying inside your circle of competence, beginners reduce risk, increase confidence, and avoid being influenced by hype. Buffett believes that success in investing comes not from intelligence, but from discipline and self-awareness. 4. Think like an owner, not a trader. Buffett strongly discourages frequent buying and selling. He believes that beginners who trade too often usually lose money due to fees, taxes, and emotional decisions. His ideal holding period is famously described as forever. When you think like a business owner, short-term price drops do not scare you. Instead, they become opportunities. Buffett teaches beginners to welcome market declines if the business fundamentals remain strong. Volatility is not risk, ignorance is risk. By adopting an owner's mindset, beginners learn to focus on long-term value rather than daily price movements. This approach builds confidence and removes stress from investing. 5. Patience is the beginner's greatest advantage. Buffett believes beginners actually have one major advantage over professionals: time. When you start early and stay patient, compound growth works in your favor. Even small investments, if left untouched for many years, can grow into significant wealth. He reminds beginners that wealth is built slowly, quietly, and consistently. There are no shortcuts. Those who try to beat the market quickly often end up beating themselves. Buffett's tips for beginners in the stock market. In the first part, we focused on mindset, patience, and thinking like a long-term owner. Now in part 2, we go deeper into how Warren Buffett looks at companies, what beginners should analyze before investing, and how to avoid the most common mistakes that destroy new investors. 1. Focus on strong businesses, not stock prices. One of Buffett's most important lessons for beginners is this: price is what you pay, value is what you get. Beginners often make the mistake of focusing only on stock prices, whether a stock looks cheap or expensive. Buffett teaches the opposite approach. He first studies the quality of the business, and only later looks at the price. According to Buffett, a strong business has a clear and simple business model, Consistent profits over many years. Loyal customers. A competitive advantage that is hard to copy. For beginners, this means avoiding companies that are constantly changing strategies, losing money, or depending on hype. A great business can survive economic downturns, competition, and time. Buffett prefers boring, predictable companies over exciting but unstable ones. 2. Understand the company's competitive advantage moat. Buffett often talks about an economic moat, a protective barrier that keeps competitors away. For beginners, understanding this concept is crucial. A company with a strong moat might have a powerful brand, cost advantages, unique products, strong distribution networks, customer loyalty. Buffett believes that without a moat, profits are temporary. Competitors will enter, prices will fall, and returns will disappear. Beginners should always ask, why can't another company easily replace this business? If there is no clear answer, the investment is risky, no matter how popular the stock is. 3. Look at financial health, not just growth. Many beginners chase fast-growing companies, assuming growth always means profit. Buffett warns against this thinking. Growth without profitability is dangerous. He teaches beginners to look at consistent earnings, healthy cash flow, manageable debt levels, stable profit margins. Buffett avoids companies drowning in debt because debt removes flexibility. During hard times, debt-heavy companies collapse quickly. Beginners should remember that financial strength is more important than fast growth. A slow-growing but stable company can outperform a fast-growing weak company over time. 4. Trust management, because people run businesses. Buffett believes that even a great business can fail under poor management. That's why he pays close attention to the people running the company. For beginners, this means looking for management that is honest and transparent, thinks long-term, not short-term, treats shareholders fairly, avoids unnecessary risks. Buffett prefers managers who act like owners, not gamblers. He dislikes companies where executives focus only on bonuses, stock prices, or media attention. Integrity and competence matter more than charisma. 5. Avoid common beginner traps. Buffett repeatedly warns beginners about mistakes that look small but cause big losses over time. Some of these traps include chasing hot stocks, following tips without research, overtrading, panicking during market drops, investing money needed in the short term. Buffett teaches that the stock market will test emotions. Beginners who lack discipline often sell at the worst possible moment. He reminds investors that doing nothing is often better than doing something foolish. 6. Long-term value beats short-term noise. Buffett ignores daily market noise. News, rumors, and short-term predictions do not influence his decisions. Beginners should adopt the same habit. He advises investors to focus on business performance, long-term trends, fundamental value. Markets can stay irrational in the short term, but over time, they reflect real business value. Beginners who stay calm during volatility gain a huge advantage over emotional investors. Advanced Buffett Principles for Beginners. In Part 3, we move beyond the basics and dive deep into Warren Buffett's advanced principles that even beginners should understand. This part is crucial because it reveals how Buffett thinks about risk, diversification, patience, and decision-making, and why his strategies have stood the test of decades. 1. Risk is not about volatility, it's about permanent loss. Many beginners assume that risk is just the stock price going up and down. Buffett has a very different definition. Risk comes from not knowing what you're doing. According to him, a stock dropping 10% in a day does not equal risk. The real risk is losing your money permanently because you bought a company without understanding it. Buffett teaches beginners to focus on the business fundamentals, not daily stock prices. Avoid companies with unclear business models. Avoid high-debt companies that can collapse during crises. This approach encourages patience and rational thinking. Beginners who fear every market dip are more likely to make emotional mistakes, while Buffett thrives during such periods. 2. Margin of safety. Protect yourself from mistakes. Buffett learned from Benjamin Graham that a margin of safety is critical. This concept means buying a great business at a price significantly lower than its intrinsic value. For beginners, never overpay for a stock. Look for companies with strong earnings, reliable cash flow, and consistent growth. Calculate intrinsic value conservatively. The margin of safety ensures that even if you make small errors in analysis, your investment is protected. Buffett emphasizes, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. 3. Patience is the ultimate advantage. One of Buffett's most repeated lessons. The stock market is a device for transferring money from the impatient to the patient. Beginners often panic when prices drop or chase when prices rise. Buffett instead holds quality businesses for decades. Lets compounding work in his favor. Avoids frequent buying and selling, which increases costs and risks. Patience multiplies returns because great companies grow earnings consistently over long periods. Beginners who rush lose this edge. 4. Concentrate on what you understand. Buffett's famous circle of competence principle says, invest only in businesses you understand. For beginners, this is crucial. Avoid trendy or complicated companies if you can't analyze their business model, revenue streams, and risks. Focus on industries you are familiar with. Learn the company's products, customers, and competitors. Ignore hype or rumors from social media. Understanding reduces risk and increases confidence in decision-making. 5. Avoid over-diversification. While diversification is important, Buffett warns against over-diversification, which he calls diversification. For beginners, owning 50 to 100 random stocks doesn't reduce risk effectively. It spreads your capital too thin and reduces potential gains. Concentrating on a few high-quality businesses within your circle of competence is more effective. Buffett usually holds 20 to 30 high-quality stocks, or even fewer, and focuses on their long-term performance. 6. Think like a business owner, not a trader. Buffett always emphasizes the mindset of an owner. Focus on business value, not market price. Think about earnings, cash flow, and growth over decades. Ignore short-term volatility. Beginners who act like traders make impulsive decisions. Buffett's approach teaches that true wealth comes from owning companies, not stocks. 7. Emotions are the enemy. Buffett repeatedly warns about fear and greed. Fear causes panic selling during market drops. Greed causes overpaying during booms. Beginners should remain calm and rational. Analyze facts, not headlines. Avoid emotional trading. Buffett says, be fearful when others are greedy and greedy when others are fearful. This contrarian approach is counterintuitive but highly effective. 8. Patience with compounding. One of Buffett's most powerful lessons. Time is the friend of the wonderful business. Compounding is what transforms small investments into massive wealth over decades. Beginners should start early, even with small amounts. Reinvest dividends. Focus on long-term growth, not short-term gains. This requires patience and discipline, but it's the cornerstone of Buffett's success. 9. Avoid speculation. Stick to investing. Buffett distinguishes investing from speculation. Investing, buying a piece of a good business with a long-term horizon. Speculating, betting on short-term price movements. Beginners often confuse the two. Buffett warns that speculation is gambling, while investing is disciplined wealth creation. 10. Learn continuously and apply knowledge. Buffett reads 500 to 600 pages daily. Beginners don't need to read that much, but continuous learning is essential. Study businesses, industries, and financial statements. Analyze mistakes and successes. Adapt lessons from other investors. Buffett believes that knowledge compounded over years is a huge advantage. Implementing Buffett's wisdom in real stock market decisions. In Part 4, we conclude our deep dive into Warren Buffett's investing mindset by showing how beginners can take all the principles from previous parts and actually apply them in real-life investing. This part is extensive because it combines theory with actionable steps that any new investor can follow to emulate Buffett's success. 1. Create your circle of competence. Buffett always emphasizes investing only in what you understand. Beginners should list industries or businesses they know well. Research companies within these sectors. Avoid investing in businesses that are too complex or unpredictable. For example, if you work in tech, you may have a better understanding of software companies, while manufacturing may require more study. Staying within your circle of competence reduces risk and allows more confident decisions. 2. Analyze financial statements. Buffett spends countless hours analyzing balance sheets, income statements, and cash flow reports. Beginners can start by learning basic metrics like revenue growth, profit margins, and debt levels. Looking for companies with consistent earnings over years. Avoiding companies with high leverage or inconsistent cash flow. Even simple analysis can reveal whether a company is a long-term winner or a risky bet. 3. Determine intrinsic value. Buffett always compares the market price to the intrinsic value of a company. Beginners should estimate what the company is truly worth based on earnings and growth potential. Use conservative assumptions to prevent overpaying. Only buy when the market price is below intrinsic value. This ensures a margin of safety, one of Buffett's key concepts. 4. Build a focused portfolio. Rather than buying many random stocks, Buffett advises concentration on high-quality companies. Hold 10 to 20 businesses maximum. Focus on companies with strong management, products, and financials. Review holdings periodically but avoid frequent trading. A focused portfolio allows beginners to monitor and understand each investment better and benefit from compounding. 5. Practice patience and long-term thinking. Buffett's greatest advantage is his patience. Beginners should buy quality companies with a 5 to 10+ year horizon. Ignore short-term market fluctuations and daily news noise. Reinvest dividends to compound growth. Remember, the stock market rewards discipline and time, not speed. 6. Manage risk carefully. Risk in Buffett's eyes is losing money permanently, not daily volatility. Beginners can manage risk by avoiding businesses they don't understand, maintaining a margin of safety, keeping some cash available for opportunities or downturns. This mindset prevents impulsive decisions and protects capital during market crashes. 7. Learn from mistakes and successes. Buffett constantly reflects on his mistakes and studies other strategies. Beginners should keep a journal of all trades and decisions. Review what went right and wrong. Apply lessons to future investments. Continuous learning compounds like money, creating a long-term advantage. 8. Control emotions. Emotional discipline is crucial. Fear leads to panic selling during drops. Greed leads to overpaying during booms. Stick to your analysis and strategy, not headlines. Beginners who maintain control are much more likely to achieve consistent long-term results. 9. Think like a business owner. Buffett invests as if he owns the whole company. Consider business performance, not stock price. Analyze management quality, product durability, and competitive advantages. Ignore market hype and short-term swings. This mindset shifts beginners from traders to true investors, focused on value creation. 10. Start small and scale gradually. Finally, beginners don't need millions to start. Buffett started with small investments and scaled over time. Beginners should begin with small amounts to practice analysis and patience. Gradually increase exposure as confidence and knowledge grow. Stay consistent, even during market turbulence. Consistency and discipline, more than timing, are the keys to wealth accumulation. Conclusion. Applying Buffett's wisdom. By following these steps, beginners can identify undervalued businesses, minimize risk while maximizing potential returns, build a focused, long-term portfolio, develop patience, discipline, and emotional control. Warren Buffett's principles are not magic, they are a repeatable framework for intelligent investing. Beginners who commit to learning, practicing, and staying patient can steadily grow their wealth over decades, just like Buffett. This concludes our Buffett series for beginners, turning theory into practical steps anyone can implement in today's stock market.